It's a pleasure to be with you all this morning and talk about this increasingly important topic for private equity of upskilling the portfolio company organization to be able to deliver the full potential plans at pace. So the question to begin is, why is this important now to worry about not just the senior leadership, but also the rest of the organization? You know, the problem today with private equity is there's just too much money chasing too few deals, and that's driven up the transaction multiples, as you know, between 10 and 12. And the question is, how will private equity assure risk-adjusted return for the invested capital, especially if you look at the public markets, which are returning also quite significantly. So what are the value creation levers that need to be pulled? If we look at this a little bit historically, since I've been in private equity for 17 years, working with diverse funds, you know, if you look at the incremental value creation on the vertical versus over time, the effort and expense required, we really see three waves. The first wave being financial leverage and alignment of the incentives of the management with the sponsor. And that was fantastic up until around 2005. And then as a point of diminishing returns, more effort was put in to implement performance improvements in the portfolio company that would drive better financial returns. And those were usually pretty specific. Top line around pricing, bottom line around purchasing cost reduction. That's where operating partners were increasingly integrated into the fund, as well as more extensive use of consultants. But all those kinds of performance improvements are now also priced into the deals. And the key question is, what's the next level driver of value creation that is going to deliver the expected returns? And Bain, in its report in 2020, put it quite succinctly, saying, you know, there's money still being deployed, but there's much more work needed to generate the returns. And it's really the third wave of value creation. So what does this mean for the portfolio companies themselves? What we see in working across many different firms over the years is that fundamentally what got the portfolio company to where it is, which is usually a successful company, is not enough to get it where it needs to be for executing the full potential plan. The plans themselves over the years we've witnessed have become more ambitious in terms of what is to be achieved. Really transformative deals. Things like acquiring an anchor investment in Europe and then 3 bolt-on investments in the United States, former competitors that need to be integrated to create the first international leader in a space. Those are the types of deals being done increasingly. Also, faster delivery of the returns, because the longer you hold the asset, the more risk you're exposed to. In general, I would say it's clear that more and more risk is being taken in order to achieve an acceptable return. And that leaves less room for error in the implementation. I think that's where the upskilling really comes into play, because it's not a matter of just getting the senior suite correct, but also how do you translate that down into the organization to accelerate the changes where the rubber hits the road. So what are the kind of transformational deals that we often see, and what implications do they have for upskilling? Well, some of the most common ones are moving from a product to delivering a service to realize more of the life cycle profit from the product. And if you think about that, even just at the beginning of that shift to services is, how do you sell services properly? So a sales force which is used to selling product that is trained and enabled to be able to sell a service in addition to the product, whether that's after sales service or retrofit or other things. So already there, but it's more than that. It's also, how do you manage a service organization properly? Sort of management processes that are needed to do that. Another common area is moving an offline business online. So if we take something like a data business where your product is reports, or a directories business, the offline skills are get it perfect because you publish once a year. The online skills are completely different. You need to publish every single day with updated information. And these are completely different management processes again, and completely different cultures that are required, and completely different skills. Same sort of thing happens in moving a good farming organization that has had stable sales to grow top line faster with hunters. Again, here, selling as a farmer, upsell, cross-sell, versus hunting new accounts and prioritizing these, again, here all the management processes required for hunting are quite different than for farming. Same thing happens with moving a business from a national framework into an international business. And I would say the most important and most ubiquitous skill shift that we see as necessary is moving the middle managers, especially in, I would say, primary deals, to be entrepreneurs. And I'd like to say a little bit more about that challenge because it's one that we see is consistently underestimated with buyouts. So the challenge here is that when the governance changes at the top from a corporate or a family-run business to private equity, a huge number of things change that are very quiet and most people don't really fully explicitly recognize. In particular, the risk profile of the private equity investor and the delivery requirements on financial performance, also transparency, that changes overnight at the transaction. At the same time, we've got a lot of employees today, especially the most valuable experts within our organization who we need to rely on to implement changes so that the rubber hits the road. Increasingly, they've got concerns around work-life balance and other aspects that might be different than the private equity sponsors need for a financial return. And it's the leaders in the middle who are responsible for translating those financial requirements from the full potential plan into motivated employees on the front line who can make and execute the right decisions quickly to deliver the plan on time. Now, these leaders, as you can expect, there's a broad variance of the skills and capabilities among the leaders in any organization. Here, the quantification of skills and competencies on the vertical, and for a typical organization, the spread. Here, obviously, it's important that this is objective information and not subjective information, but with the right process, you can get objective information, and you see a big spread. And then the question becomes, okay, how do you improve our average leadership performance? Oftentimes people would focus immediately on the top performers, but most of the time the top performers will always be the top performers. The key is, how do you lift the average? And that, economically, the best way to do it is to lift the poorest performers out, either by replacing them as a worst case, but better is to do specific development and training that's necessary to get their performance up. So maybe just to wrap up, a few of the lessons learned in how to upskill the organization over the years, and what are these secrets of success in upskilling for private equity? I would say the first thing is really to working backwards from the full potential plan to understand what skills and competencies are going to be required to deliver that plan. And here, what got you there won't get you there. There's oftentimes a brand new set of skills, often around digital, probably around sales, but to work back from that. The next thing is to have a fact-based understanding of where your skills and competencies stand today. And with that combination, to understand where specifically, down to specific roles, specific competencies, certain people, where are the gaps. And then move quickly right after the deal. Not wait and see, but with good facts and a clear understanding of what you need to move and act on that and get the right people in the right roles in place as soon as possible. In addition to that, we see that focused training where it's really needed, similar to what was just explained in the last case example, is quite helpful in filling the gaps. People all want to succeed, but oftentimes in the new private equity governance setup, they don't know what they don't know, and that training can be very helpful. The next point there being is to set up and establish processes in the organization to continuously develop people. That was also referred to in the last case example around coaching and getting that rhythm set up and enabling continuous development of, in particular, the middle managers. And then finally, the signaling of the senior team and the senior executive in particular. Who is hired? Who is let go? Everyone is watching, and these are things that help in accelerating the upskilling of the organization. So I hope that with this short presentation, that we understand why is this important to spend time on upskilling other parts of the organization, not just the senior leadership. 2, what types of upskilling are generally required, or where are the areas that are commonly upskilled? And 3, what are some of the best practices in terms of addressing upskilling issues? So with that, I'd like to say thank you.